Hey, welcome back to the channel. Today we're going to do a very brief look at Dollar General. So I've been looking into this one over the last several days along with other retailers, and I wanted to just put a quick video out there on it. So as you can see, we've had a really nice pullback here recently. We've got the 5-year chart up and we're sitting about 40% down from all-time highs. We're currently at about 155.50 with COVID lows was around 140 and pre-COVID price was sitting right around where we are right now, right between about 155 and 160. Now, I did listen to their earnings call today, along with I've been listening to other retailers as well, as I think we've seen some pretty good weakness in the retail space, and we've kind of heard more of the same from them. Basically, a declining consumer as far as the strength of consumer. We've been seeing like less spend in discretionary items and more spend towards staples, and really just a kind of a crunch on the consumer. They've been affected recently by the decreases in the SNAP limits, as well as increasing shrink or increasing theft. And we've seen that with a lot of different retailers, Walmart, Target, Dollar General, Ulta as well, basically every retail call that I listened to. And the narrative from the company on the call was pretty much keeping up their expansion plans. I think they're decreasing the planned store amount or new store amount a little bit, but focusing on expansions, focusing on efficiency and cost cutting, and really keeping up their CapEx expansion though through this time. And they did mention that they were actually going to pause the share buyback plan through 2023. So unfortunately, we probably won't see buybacks through 2023, which could be pretty unfortunate if their price continues to fall into this 100 to 150 range, which seems to be at a pretty good valuation. Now, if we go over to the valuation sheet, we're gonna check this out. Let's go over to the income statement, and for some reason, my software is pulling this in as 2024. That's not correct though, so we can just look at the previous 10 years financials, and we can see increasing SG&A and operating expense along with the increase in revenue over the years. They've been a share repurchaser in the past, reducing a decent amount of their share float from about 325 to now 220 or so. EPS diluted has constantly increased. If we look at their kind of last 5 years, their growth metrics, we kind of see, net income growth about 8.73%. Free cash flow growth is down a ton, and that's mostly because they're rolling a lot of their income into expansion of new stores and kind of gaining efficiencies, doing R&D, increasing their tech stack, and trying to make their operations more efficient. So a lot of that free cash flow is going into reinvestment right now. So for that reason, I'm pretty much doing this evaluation based off of net income or EBIT. So net income has seen about 8.73% increase over the last 5 years. You can see it's been a pretty steady grower since 2013. Their bottom line yields have gone pretty much between around 5%, 4.5% to maybe 7.5%, 8%. And going over to the balance sheet, we can kind of see their cash on hand. It's about 313. Their debt is right around 16 billion. Most of that looks like it's going to be in capital lease obligations. So it's mostly leases, and then probably what we're going to have around 5-6 billion in long-term debt. Then going over to their cash flow, we can see operating cash flow. Stock-based compensation is relatively small. They have a decent amount of depreciation and amortization, and then a large amount of investment in property, plant, and equipment and capital expenditures, as they were rolling a lot of their free cash flow into expansion efforts. Here we can see the common stock repurchased, common stock issued, dividends paid, and debt repayment. A lot of their free cash flow has gone towards debt repayment. We have a decent amount of common stock repurchased and a steady dividend that has been growing as well. I'm a little bummed that they're not going to continue this stock repurchase plan through kind of this drawdown, because we are reaching some pretty attractive levels, and especially I think if we get down to the $100 area, which would be fairly attractive when we look at historical multiples and what they've been able to trade at before. So you can see over the last 10 years, they've had pretty steady gross margins, operating margins, and net margins. Maybe a little bit of expansion on the net margin side, but relatively flat, starting off at 5.59 and they're at about 5.51 right now with a little bit of fluctuation here and there. We'll go over the per share metrics. We can see a decent amount of growth and a recent pullback here. And if we go over to, and that's for operating cash flow and free cash flow per share. If we go over to their return on equity, got return on equity around 8 to 11%. Return on capital employed is about 3%. Return on assets is about 1.73%. And then here we get a little bit better look of per share metrics on a yearly basis from 2014 to 2023 right now. So solid per share growth with recent pullback. Then here we have the common stock repurchase over the last 10 years. It typically ranges about probably 0.5 to 1% per quarter, sometimes going higher, sometimes lower. And then for those that like dividends, we can see they started their dividend in, it looks like 2015, steadily growing their dividend into 2023, and their current dividend payout ratio is about 0.25. So the payout ratio seems to be pretty healthy. And then for our growth metrics, we can see revenue growth and gross profit growth over, let's see, the last 10 years, usually around 7 to 10%, right around there. Then they were buying back shares on top of that. So that's when you get that EPS growth of probably closer to around 10%. Dividend growth, it looks like it's been about 11, 10, 12, 16, 30. So probably ranging between, low years of like maybe a 5% growth and average is probably around about 10%. All right, and then getting into the valuation, I've got a target rate of 15% here. So base KGAR, 12.5% target, 2.5% margin of safety, dividend yield about 1.44. And for the dilution, we're looking at a range of 2.19% buybacks in the very bearish scenario with 4.19% in the very bullish scenario. This could probably be changed since they are planning on not even doing buybacks this year. We could probably put that at a larger scenario spread, maybe like a 20%, and say that the low end is about 1.72. So let's go ahead and do that. If we look at the bottom line growth, what we want to do is this number is kind of jacked up from taking into account free cash flow growth, which is highly negative due to the reinvestment into the business. So if we look at bottom line growth specifically just for net income over the last 5 years, take that average of about 8.73%, and that's what we'll use pretty much for our top case. So we'll do a 8.73% top case. Let's do a scenario spread of maybe let's do 12.5%. So negative 12.5%. Have a little bit worse. So the very bearish scenario would be about 5% growth, and the very bullish scenario would be about 8% net income growth. So we are doing this normalized over net income, and we can see that this gives us kind of the 5-year yield multiple of about 8% in the very bearish scenario, or 4.96% in the very bullish scenario for net income. Back down to the previous bottom line yields, we can see that net income is typically range probably between 4.5 or 4.3 up to about 6.95. So we do have kind of like multiple contraction in the worst case scenario, and we also have probably a little bit of multiple expansion in the best case scenario, but the base case is sitting at right at like 6.3, which is pretty much close to that average. And what I think I'm going to do is I want my target rate, including dividend, to be about 15%. So I'm going to lower the base KGAR a little bit, probably to around 11. So we have about 13.5% target because we're getting about 1.5% dividend, which would equal around a 15% total KGAR on this. So that kind of puts us into the very bearish scenario, buy price of 105, bearish of 126, base case of 152, which we're almost there right now, bullish of 186, very bullish at 231. Then if we go over to the pricing chart here, we can kind of see fair value on a 1 year forward-looking basis is probably between current and 1 year forward-looking, between the very bearish and the base cases, is between about 103 to 196. So you could say we're probably in a close to fair value right now. But that, of course, assumes that we see a normalization and a return to previous historical growth trends. So Dollar General is going to kind of be a retail play on the, I would say, lower end consumer, the more spend conscious consumer, and the more rural consumer. So you're targeting kind of that demographic when you're looking at Dollar General for a retail play. Across our 5-year targets, the very bearish 5-year target would be 196. The bearish target would be 235. The base case would be 285. The bullish it would be 348. And the very bullish would be 431. And also, if we do change that base CAGR to kind of be more aggressive on the returns that we want, say we want closer to 20% total return, then, you know, the buy prices are going to change obviously drastically. So if we're looking at 20% returns targeting, you know, we're really looking at probably that $100 range in order to get close to that type of return given kind of this valuation model. Now, I know that we talked specifically about Dollar General in this video, but I think the retail space in general, there are a lot of interesting potential opportunities. I don't think it's like crazy undervalued in any kind of specific area right now. A lot of them are probably historically getting probably around fair value or maybe a little bit better than fair value. But we're starting to see kind of some selling off into a lot of the retailers. You know, we look at Target has sold off, Ulta Beauty has sold off, Dollar Tree has sold off, Dollar General is sold off. Another one's like ASO is sold off pretty well. So we're starting to see kind of this like longer term potential downtrend in the retail space. Now, it's hard to say how long this could last, but it could be potentially an area of opportunity to keep an eye out on and probably do some initial research and then a lot more research and kind of find the players that you are most interested in if you are looking to accumulate in this sector. All right, well, that's all that I got for you guys today. I hope you have a great day, and we'll catch you later.